Hello, everyone. Welcome to the market update for Tuesday, April the 6th. The trading I'm going to do at the end of the update is going to be on the Dow Theory. Just so you're aware of that topic, talk about what the Dow Theory is and how we can use it within our trading system to help us. And I'll even add something to it that there's another indicator that a lot of people nowadays will use in a similar way, and we'll talk about that during the training. All right. Now, the last couple of weeks have talked about how the market looks like it's getting set up for a pullback. You wouldn't maybe feel that way with the way it's performed the last few days, and so where it's kind of seems like it's going straight up. But there are some signals that are starting to show up that are indicating a little bit of a warning ahead that we could get a little bit of a sell-off or pullback, which is good. We really need it. I think part of the reason why the rally has been a little bit sluggish for the last couple months is because we haven't had any decent pullback. And again, people aren't aggressively buying things when they feel like things are a little expensive or a little overdone. And the market is definitely getting into a condition where it's getting overbought. So let's go through some of those clues. One of the ones that jumps out right here on the directional alerts page is that whenever you see sentiment, which is the blue line right here, above momentum, which is the red line right here, and both of those lines are above the breadth line, which is the green line, which is right here, which is what we have right now. We have that stacking order right there. It indicates a tired market. Now, again, a tired market can wake up again and start taking off again. It doesn't. That alone isn't going to suggest that we have to get a pullback right here or that we're going to sell off. And I think that's really important. I emphasize this all the time. You can't look at one analysis alone and make a major decision. You want to look at all the different clues that are showing up and combine them. And when they all start kind of flashing the same thing, that's when you really want to pay attention. Or maybe not all of them. Very rarely do you get all signals pointing to a rally or a sell-off. You know, that's why indicators are so especially if you focus on one indicator, it can be dangerous because they can't tell you exactly what's going to happen. But when you get a bunch of these kind of flashing at the same time, you definitely want to pay attention. And it still doesn't mean you know what's coming, but you can prepare and make decisions based off of that analysis that can definitely help you out. So if we start to see a weakening market right now, again, we can limit the amount of new trades we're getting into, tighten stops on trades we're in, maybe sell some of the positions to go to cash a little bit so that we're not harmed by any big sell-off that takes place. Because everyone wants to make a lot of money on the run-up, and ideally you'd like to be able to get out when it pulls back, and because now everything goes on sale and everything can go right back up again. And ideally that's what you want to do, is you want to buy low, sell high. That's kind of the whole goal here. But there's one of the things from a human nature standpoint that prevents us from doing this a lot of times is because there's a greater fear sometimes, which is the fear of missing out. We're afraid that if we get out right now and it keeps going higher, which it definitely could do. I mean, I've been talking about the market starting to look a little toppy. We started to see a little bit of warning signs over the last week that we could be getting a little bit of a pullback. But we have gone higher, and sometimes you might see some of these clues, and the market still goes higher, and you're upset because you're like, man, I missed that. Why'd I get out when I did? I could have stayed in, made a lot more money, and that fear of missing out can sometimes be strong enough to where it prevents you from acting when you see some of these warning signals. I think the biggest thing that helped me over the years deal with that fear of missing out is to focus on the time frame that you're dealing with. I can always get back in. It's not like I have to get out, or if I miss a move, it's the end of the world. It's never going to happen again. I think what really fuels the fear of missing out is when you when you feel like there's a time limit on your success in the market, like you've got to double your money by the end of the month or something like that, where you feel like you put these restrictions on you where everything has to happen within this time frame that you expect it to happen. And when you realize that, you know what, if I miss a trade, there's going to be another one that comes around tomorrow or within a few days, it helps you be patient. It helps you feel like you don't have to be impulsive, that you don't have to, react in such a way that is going to be detrimental to your trading. So this is indicating a tired market, and so that's a good starting point as we go and look at some of these other indicators. Momentum indicator is on the far right side of the extreme range. So now again, market can continue to go higher even though you're in an extreme range, but that's something to note, that we're in an extremely overbought kind of condition there. And it does increase the bearish risk when you get into that extreme range, and especially when you're at the far right of that extreme range. You really have to recognize that. So at the far extreme right of momentum, the breadth indicator is in this extreme range, but it's not yet at the far right side of that, but it's already in the extreme range. Very rarely you're going to get all of them lining up in the far right of the extreme range. So that's kind of unrealistic to expect that. Sentiment is still, it's high, but it's not in the extreme range, but it's trending that way. We're getting pretty close to that. And then when you look at the buy-sell ratios, these aren't showing extremes just yet. They are widening out, but they have been wider before. So I don't see a big problem there. The sentiment indicator here is in the extreme range. When it gets above that red line, very often you'll get these little pullbacks. Here it went to that extreme range. We got a little bit of a pullback in the market. Some of these other ones we've got pullbacks after it's hit that extreme. But there again, not that alone, but as you're seeing here, we're starting to see some of these things line up. Now, it's also interesting, and I don't look at this all the time, but when it looks like the market is starting to get into a little bit of an extreme condition, a little bit overbought or a little bit oversold, I'll take a peek at the indexes right here. And one thing that I noticed, normally in just a normal market condition where the trend is just kind of moving along, you could be anywhere between 2 to 5 times the buys to sells. I'm talking about an uptrend right now, so like a 5 to 1, 5 times as many buys as there are sells, or 2.5 times as many buys to sells. That can tell you that there's still a lot of stocks that are in the sells that can move towards buys, or move to hold and then to buy. So there's still a lot of room for that trend to kind of run. But sometimes these things start to get a little bit too lopsided. And right now, if you look at the Dow Industrials right here, you're at a 21-to-1 ratio right there, where there's 21 buys and only 1 sell on the Dow 30 stocks. That's extreme. Okay, that means pretty much almost all of the Dow stocks, vast majority of them are in buys. Now, a lot of times that'll happen towards the end of a trend as opposed to the beginning. But there again, that alone is not going to, it could stay that way for a while. I mean, you could stay that way for a few months if you really get a runaway bull market. But when you're getting this and you're getting extreme overbought conditions like we're seeing on those other indicators, that's where you want to pay attention. This is signaling something. And again, this is not immediate. It's not saying we're going to sell off, tomorrow or anything like that. But a lot of times we're getting pretty close. Within a week or two, usually when we start to see all these things line up, you're getting pretty close to that. If you look at the S&P 500, it's not quite 20 to 1, but close, almost about 18 to 1. The NASDAQ or the S&P 100 right here is 28 to 1. Now the NASDAQ 100 isn't as bad. I mean, 11 to 1 is still pretty high, but it's also been kind of that's really been recently the last few days where it's kind of surged a little bit. We'll look at that chart here in just a second. But remember I talked about that chart being broken a few weeks ago. I wouldn't expect that it's going to rebound as strongly or move as strongly as the Dow and the S&P, which I figured would go to new all-time highs, which they've done over the last few days. The Russell 2000 is only about 2.5 to 1. To say, oh, that's not too bad, and that's true. But remember, that's another chart that kind of broke down. That looked like the trend broke down. We'll look at that chart here. So to me, what this is suggesting is that we've already seen kind of the NASDAQ 100 and the Russell charts break down. Could it be that we see a pullback in the other indexes and kind of alleviate this overbought condition? We'll see. And again, the bottom line is whether or not we get a sell-off right now, I think it's important that you take defensive measures when you get these conditions, because most of the time you're going to get some sort of a correction. And it may not happen this time, but there again, if it doesn't and we keep roaring higher, then I can jump back. It doesn't mean I can't jump back in, so it's important to kind of keep that in mind. All right. So they're pretty extreme conditions here on the indexes. Now, if we look at the individual charts, let's look at the S&P 500. You can see the SPY right here is it's not only in the extreme range, it's moved to the far right side of the extreme range. You can also draw kind of a trend line. I can't draw a straight line with this drawing tool, but if you kind of draw a trend line up through here, you're right at the very top of that trend line. And so could it be that you get just a kind of a mild pullback out of it, like we've seen these last couple times you've moved up to that upper part of that line? That's possible. But I actually don't want to see. I want to see a deeper one, because a deeper one leads to a stronger recovery. And again, I don't mind how far it pulls back. If I'm fully in the market, I've got everything in, I don't want to see a big pullback, because that means I'm giving back a lot of gains. But I've alleviated I've gotten out of a lot of positions where I'm kind of sitting on the sidelines because of these overbought conditions I've been starting to see. And so I want to see a deeper pullback, because it'll lead to a sharper and usually a more sustained rally afterwards. If we look at what I'd like to see is, and again, the market doesn't give you what you want to see, what I want to see, but what would be ideal for me anyway would be to get a pullback like we saw back in the fall. If we go, actually we'll go to a 1-year chart here, we can see it a little bit. So back here, even at like this in September, we had just a little bit of a deeper pullback there. October, in fact, we had back-to-back months there where we had those bigger pullbacks, and we've kind of been on this longer move since then, since we had those. This is a little bit more of a shallow one right here, but there again, what happens is a lot of times when the pullbacks are shallow is when you break out, they don't go as far. Here was a shallow breakout. It broke out a little bit and then just moved flat right away. Here it broke out, pulled back again right here. Here we've broken out again. We don't know what's going to happen. Usually when you're in these conditions, it's either going to be just more sideways or stagnant. You might still continue to move higher, but you don't get the sharper moves. We want to see something like that where where it seems like almost every day the market's kind of moving up. And it doesn't need to be a big moves up every day, but when you get those consecutive days where it's kind of going up and up and up, it's a little bit easier to make good money on your positions. And you don't get tempted to get out of them because of the whipsaws. When you get these whipsaws, it's harder to stay in trades because you don't know what's going to happen next. So we like to see those deeper pullbacks, and then when they start to reverse, we see some of those bullish reversal signs to jump back in and ride those trends back up. if we look at the Dow chart, it's not in the extreme range, but yesterday it did close at a new all-time high. It's a little bit flat today, which I think is significant. We're starting to see a little bit of this, a little bit of weakness. In fact, the volume. I think it's important to point out the volume. This will probably be the lightest volume day of the year. We only have a little over an hour to go, and look at it, just tiny volume. So we're rallying on very light volume. That's also not a very good sign. And the S&P is the same way. SPY, very light volume today. Now, as we move into the other charts on the QQQ, the NASDAQ 100. Now it surged. It is at the far right side of the extreme reversal risk range, and that's because it has been on a tear lately, which isn't too much of a surprise. If you remember from the last couple of updates, if you followed those, I said that I felt like this was forming a bearish ABC pattern right here, and so I did feel like there was a pretty strong probability that we'd see the QQQ move higher. But I also felt like it would probably terminate right around the 330 area, right in here. And actually, we moved above that today. Now, usually, here's where the trend broke down right here, where it broke that uptrend. And usually that's a warning sign. Usually, you're not going to see it go to a new all-time high off of that when it breaks the trend like that. So I'm not expecting the Qs to exceed that 338 high up here. But you just never know. I mean, I would rank it as a low probability, but you just never know. When the market gets in these conditions, it can stay overbought for a while, and it can stay extreme for a while. And one thing I pointed out a few times is that this trading period that we're going through right now, with all that's happened over the last year, it feels a lot like the internet bubble of 2000, especially with so much money being pumped into the system. Back then, it was the fear of the Y2K crisis that flooded the money into the system. And what happened was all this money went into these internet companies. All these internet companies started up, and most of them failed. And now we're seeing a lot of these new companies show up. There's a lot of electric vehicle companies that come out of nowhere. These SPACs that are coming out of nowhere. So very similar conditions. But the one thing I really remember about that period of time was that it seemed extreme back in November and December of 1999, and yet it extended all the way out until about March, April of 2000 before things kind of collapsed. So I do know that although I wouldn't expect the Qs to go to a new high out of breaking down on that chart, anything's possible. And it make it very difficult if it did to trade, because after breaking the trend and then breaking out, to me personally, that would feel like it's trying to suck in the suckers. It's trying to bring everybody in thinking, there's no way this market's going to drop, and then that's kind of, that breakout may not last very long, and then things should collapse right after that. So I wouldn't want to be buying that breakout necessarily. I'd be too suspicious of it. But one thing as a trend trader, and it's probably the toughest thing for me to do sometimes, is there's always that desire to want to predict instead of follow, and a lot of that comes from just experience. How many times I've seen things do that, where it shouldn't be breaking out and it does, and then it reverses right after that. It's hard not to pay attention to some of those past experiences, but there again, you don't want to get so caught up in your prediction or your expectation that, maybe it does shake everything off and trend for the next 8 months, and, you're missing it because you're not focusing on what is actually taking place, what is actually happening. But that's kind of where I'm at right now, is I'll reassess. If it does break out, I'll probably just take a step back, reassess what's going on, look at a bunch of other things, not just focus on that. Maybe for some reason we see, things kind of consolidate a little bit. Maybe it breaks out and moves sideways. We don't always have to pull back to alleviate overbought conditions. Sometimes you can move sideways. I always hate the sideways consolidations because you can't really make a lot of money. Well, I can say you can. It's harder to make money in sideways conditions because it's just kind of back and forth. You're not going anywhere. It's not very fun. I like pullbacks and rallies because I know how to trade pullbacks. I can make money on the moves down as well. Maybe not as much because I might be not focused on that as much. But I can make money when markets are moving. If they're moving up and moving down, I don't care. So I like movement. I'm not a big fan of sideways consolidations, but that's another possibility, is it could start moving sideways and consolidate the move, and that would alleviate that overbought condition as well. But I'd say this is kind of a critical spot right here from that. It is kind of breaking down a little bit, but again, I point to the really light volume today. It's not a significant breakout right here. So we'll see if that ends up reversing here in the next day or two. I really think that if the markets are going to start selling off, that it's going to happen this week. Obviously, with the early strength, it'd probably be later in the week. But we got an update on Thursday, so we'll see if things really look like. Still look like it'll happen this week or not. We'll probably know by then. Here's the Russell chart. Again, this chart broke down on this move right here. You had your uptrend right through there, and it really broke that trend. It didn't really go to a lower low right here, but it is an equal low. It's rebounded, but it had a weaker trading day yesterday. Although it was still up yesterday, notice that candle there. It opened higher. It opened right here and closed here. So it closed lower than where it opened, although still higher than the day before. That's a very bearish price action. And so it's no surprise that of all the indexes that although it's up a little bit today compared to that close from where yesterday is, but it's there's a lot more weakness showing up in this chart than the other charts from a candle perspective, at least in my opinion. So the Russell's really showing, and it's happening near kind of this resistance area right here. And even this is showing it could still go up a little bit higher. It doesn't have to, but there's some resistance right there. I just don't see either the NASDAQ 100 or the Russell 2000 going to new all-time highs, at least anytime soon, until we get a little bit of a deeper pullback. Now, moving on, the bond chart right here. Let's take the volume bars off because you can't see some of these charts. Bonds have rebounded a little bit, but this looks a lot like a bearish ABC pattern right here. I don't know that I would expect that to rally to last very much longer. It looks like it's still trending down. Now, what could indicate that maybe it's bottomed right here and is going to start trending up? Well, this is an easy higher high to get above. It could still be a bearish ABC pattern, like I just mentioned, and go lower. But if it starts ticking up above these other previous lower highs and so you're starting to break above these areas here, that would build a stronger and stronger case that maybe you have bottomed out. If it continues to kind of stair step as well, higher highs, higher lows. So we'll keep an eye on that, but overall, it still looks like it's trending down. I don't see any major trend reversal on that, at least not yet. Now, gold is a little interesting. Last week, it looked like we were heading lower to a lower low. We had this big drop right here, this little pullback. So we had a lower high, lower low. It looked like we were going to go to another lower low. But it held right here, and it's rebounded. So you have a slightly higher low right here. And now it could be that this is just a bearish ABC pattern. We head lower again, but we'll just keep an eye on this to see, you first see if it can break above this high right here. That would give you a higher low and a higher high. And then you'd probably want to look at this area next. That was the last previous lower high. And if it could start to work its way up that way and continue to kind of stair step up, it could be possible that's in a little bit of a trend reversal. So in other words, so it came down right here. You had this move up, this move down, kind of similar to what you've had here. This move up, this move down. This is a deeper move down though, but it broke out to a higher high right there, higher low. And then on that next pullback, you'd want to see a higher low, which it did, and went to a higher high. Now that didn't last very long and then dropped back down again, but you want to start to see that it acting like an uptrend before you assume or start to assume that you could be in a trend reversal. Other than that, the downtrend is still pretty much intact for gold, so the overall trend is still considered down. Oil, I talked about this last week, and we had not much has changed. It looks, we had this first sell-off right here, and then it's moved sideways. It should probably have another move down. This goes back to that old saying, whenever you see stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's likely to go after it's done moving sideways. And it could just be that that's a bullish ABC pattern, A, B, C, and then that uptrend continues again. But I would probably wait to see if it has that one more move down. It just kind of looks like it has a feel for that as well. And you combine that with if the market pulls back a little bit, you probably see oil pull back with it as well. The dollar, now the dollar's been weaker over the last couple trading sessions, but the overall trend is considered up. At the higher low here, higher high, higher low, higher high, and this just looks like a pullback within the trend. Should give us a higher low at some point. If not, this was the last higher low right here. So if it breaks down below that, you could, and especially if it does it, if it's kind of stair stepping its way down and breaks down below that, it could be that we're in a trend reversal and could start to see the dollar dropping. And the VIX is still low. Now the VXY, this is the ETN is what it's called. You can trade the VIX actually, which I don't recommend doing. It's very risky and really it'll leave you scratching your head sometimes how it moves the way it moves. But the VXY doesn't always mirror the VIX indicator perfectly. One thing, but it's if I want to show a chart, that's what the chart you pull up for it on Traders Pro. But one thing that I would point out is that the actual VIX indicator has actually been up the last couple trading days, not by a lot, but it's been up a little bit. Now, why is that significant? Well, one thing you've heard me say a lot is whenever you see the VIX in the market, the S&P 500, more specifically, should move in opposite directions. So when the S&P is up, the VIX is usually down. When the S&P is down, the VIX is usually up. When they move in the same direction, you always want to pay attention. And so what does it mean with the S&P 500 moving up and the VIX moving up? Well, what causes the VIX to move up is the VIX. I don't have a lot of time to go through that. I have a trading on the VIX already that you can go back and review, but it is basically called the fear indicator, and that's not a completely accurate way to describe it. But what it shows you is when professional traders are worried about the market, they will go out and hedge. They will buy those protected puts. I talked about protected puts last week in the training. And when they go buy those puts, as they're buying those puts, if they buy more of them, what happens is the implied volatility of those put options goes up. And that's what the VIX is measuring, is the movement of that implied volatility. So when the implied volatility is going up, it's showing that there is more fear amongst those professional traders because they're willing to pay those higher prices for those options because they feel like they need them. If they don't feel like they need them, they're not going to buy those protected puts or not buy them in a sudden fashion, and that volatility is going to be very low. So that's why the VIX is moving in the opposite direction of the market. When the VIX spikes up, it usually happens when the market drops because there's that fear, and these professional traders are buying those puts as quickly as they can. Now, we're not seeing a spike right now, but what we're seeing is the market up and the VIX is up. So why would professional? So what's happening is professional traders are buying protective puts, but they're also buying stocks. Now, why would you buy that protection? Why would you pay for that insurance if you don't feel like you will need it? Well, it happens because you're uncertain. You're worried about a pullback, but you're not pulling back yet, right? So it's an early signal that those professional traders are concerned that a pullback is coming. Now, because it's not spiking yet, it doesn't mean the fear is there yet, but there's concern about it. It's showing me that the professional traders don't trust the rally. So if you don't believe my analysis of the market right today and say, well, Jerry doesn't trust this rally, but who is Jerry? I don't even know who he is. So who cares what he thinks? What the VIX is saying is that the big institutional investors out there that really drive the markets, they're the ones that make the market go up and go down, are concerned a little bit. Now, there are many days where the S&P can be up and the VIX can be up, and then it can just reverse. The market can just go higher, the VIX could drop again. But again, when you start adding up all these clues, everything we've talked about up to this point, all these overbought conditions, and the professional traders are concerned about the rally, I'm telling you, a majority of the time you get some sort of a sell-off or pullback off of that condition. And it may just be shallow or it could be deeper. We don't know. We'll have to see how that plays out. But those are warning signs. And I know I'm kind of repeating a lot of stuff today, but I want to train you on this because I want you to be able to not have to worry about me. I'd love it if you didn't have to tune in to my analysis each week, because you can do it yourself and you can recognize these clues yourselves and be able to make decisions that can help you make a lot of money. All right, so that's where we're at. Real quickly here, a couple stocks, and then we want to get into the training. Under computer and technology here, and again, keeping a lot of these we're waiting for confirmation anyway on, so that's good, but just keep that in mind. I will go over some stocks that look interesting to me, but doesn't mean that I would say go in strong right here, just based on the conditions I just went over with you. But MVIS up here is interesting. It has a 100 strength rank. It's at the top of the list here. Let me switch this back over to signals here. But what I found interesting on this chart is that you had a double bottom right here, and then you've had a lot of resistance right in here. It has not been able to get above that 19 or about $19, and it's pulled back the last couple of days right here. Again, this would be a good one where you're waiting for confirmation anyway, because the market sells off in the next few days, this thing will probably drop and it won't matter. But if it can break out above this area here, and probably around that same area is when it go back to a buy signal, there'd be a pretty good chance it could rally back up to at least come up and test that previous high up there. Obviously, if it were to break down below here, you probably wouldn't want to mess around with it. Let it go. It's probably in for a deeper pullback at that point. That one looked a little interesting to me. I mentioned this one last week under autos here, but Tesla. Now, the Tesla chart. I pointed this out. I can't remember which day I went over this, but it's already had this big pullback right here. I thought, well, this could be the start of a new upward trend, kind of a wave 1, wave 2, and then go into wave 3. But I also point out that this could be wave A, wave B, wave C, and then you can get a bigger sell. It could continue the sell-off right there. But this is one where I don't expect it to. I'm not expecting it to. If it is a bearish ABC pattern, I'm not expecting it to get all the way back up here. But if you look at the QQQ chart, that's kind of what my analysis was on the QQQ chart. I felt like this is a bearish ABC pattern, and that it was going to lead to another move down. But if QQQ ends up breaking out, I would be pretty confident that Tesla is probably headed for the same thing. So it'd be much more likely that this would be wave 1, wave 2, and this is wave 3, wave 4, wave 5. You're in a, you could end up at least getting back up to that previous high or even breaking out. So anyway, I throw that one out there is one that, keep an eye on, especially if the Qs break out. There's probably a good chance that you'd see Tesla maybe catching up, maybe money flowing back into Tesla. And then under business services, under the hold section here, 98 strength rank, this SWTU Holdings Limited, SWTU. Now, I already like the fact that this looks like a bullish ABC pattern on this pullback right here, correcting this larger move up. But you've had this little move off the lows right there, and then you pull back again. Now, this could have more back and forth to it, and definitely more downside in the near term. But this could be forming an inverse head and shoulders pattern, which is a very bullish formation. There'd be your neckline right there. Now, like I said, usually the left and right shoulders terminate in about the same spot. So this would leave a little bit more room for this to pull back too, if it still wants to pull back. It doesn't have to. Or it could have more back and forth where it rallies a little bit and then comes back down and then but if it can break back up above this neckline, that'd be a pretty bullish signal there. So, and that's probably about the point where it would be close to going back to a buy signal as well. So all these I've kind of shown you here probably need a little bit of confirmation, which is good. But they're definitely ones to keep an eye on if the market does break out and go higher, especially on the NASDAQ 100 there. That these are some that you can maybe jump into and could be nice patterns to get into. All right, let's get into the trading now, and it's going to be kind of a brief trading today, but some of these are just important things I've learned over the years. I don't use them all the time, but there are key moments where you pay attention, and what we're going to go over today is what's called the Dow Theory. It's been around for a long time, over 100 years, and it basically the behind the theory, it's basically that if you look at the transportation stocks, they can give you a clue. They can give you a little bit of a leading indicator of the market, of the overall market. Meaning that by transportation stocks, I'm talking about the railroad stocks, the airline stocks, your Federal Express, your UPS, trucking companies. As these companies are doing well, it tells you the economy is doing well, right? People are flying, people are buying products, so they need to be shipped. Federal Express, UPS, railroads are transporting products. When your economic conditions are not as strong, then then you get obviously less products are being ordered, less products are being transported, people are taking fewer flights. So it can be an indication of the strength of the economy, and thus usually it relates to the strength of the markets. And so what you look for is you look for confirmation or divergences. Let me show you an example. Now the Dow Transportation Index is made up of these different companies: railroad stocks, airline stocks, Federal Express, UPS, trucking companies. You can track it by using, and you can even trade it by using the ticker symbol IYT. Now, usually with the Dow theory, usually what you're analyzing is you're analyzing the Dow transports versus the Dow industrials. So the Dow 30, the Dow Industrial Average, the 30 Dow stocks. You're comparing those charts together, and that tends to work about best when you're using it that way. But and I'll tell you right now that this is one that's a very general indicator. You want to use it, like I said, with a bunch of different analysis. It doesn't show you anything, or show you things every day. There can be slight divergences on a regular basis. You're going to have periods where the days where the Dow is up and the transports are down, or the Dow is down, the transports are up. As you can see right here, the Dow transports, I mean, look at the strength of that rally over the last couple months, and let's compare that to the DIA, or the Dow chart. I mean, the Dow chart was still moving up, but it was a little bit more back and forth. I mean, that IYT was pretty much straight up. So what is that telling me? Well, it's telling me that the transports are showing that the economy is really looking good right now, and that's obviously when you look at the COVID starting to calm down, and people are going to be getting out and buying things and doing things, and you got all this money poured into the system that's going to fuel a very hot economy. So that is definitely reflecting that in the transportation index. So what would I look for, though, using the Dow theory? Well, very often what will tend to happen is the transports tend to be leading the way. So if I start to see the transports break down, but the Dow index going higher still, that could be an early warning sign that a pullback could be coming. Okay. Now, obviously, I don't see any warning sign right now, but I do have a little bit of a couple bearish kind of candles. Well, here's an indecision candle from yesterday, and then a little bit of a bearish candle today. So that's not a real strong indicator from the transports. But if we look in the past, you can see some areas where it was a little bit of that leading indicator. If you go back to the big drop that happened with COVID last year, here's where the transportation index peaked out. It reached its highest peak on January the 16th. And then it tried to rally right here, but it had a lower high right here on around January around February 12th. And February 12th was the right before we had the big drop. So you had the transports having a lower high right before you have this big drop. If we look at the Dow in that same period there, it had this peak right here early in January, it had the pullback, and then it actually went to a higher high. So in other words, what happened is the Dow went to a higher high, but the transports didn't confirm it. They didn't go to a higher high at the same time. Again, that's a warning signal. It's not, oh, just because it happened one day, everything's going to fall apart. But again, you start combining different indicators. In fact, there were a number of things flashing right here. I made a call that we were within a couple weeks of a drop. I didn't know it was going to be that big and that fast. But there were a lot of warning signs that were flashing. This is one of them. There were a lot of warning signs that were flashing right around that period of time that were saying, hey, we're about to get a pullback here. Now, it can also work the opposite way. What happened down here is that you had a low right here, and then a few days later, the Dow index made a lower low. But if you look at the transports, the IYT, it had bottomed those few days later, and it actually had a higher low right there. Very subtle, but as the Dow went to that lower low, the transports didn't confirm that. They didn't go to a lower low. Now, again, and I could point to a number of cases where you had that a little bit of that it didn't confirm the move, and then something happened later on. I can't emphasize enough. This can't be your primary analysis, but it is. There is something to it. It does work enough times where it's at least throws out a warning sign, or as in the case down here, it threw out a sign not to be worried. That hey, the market, the Dow went lower, but the transports didn't go lower, and we've already had this big drop. That something like that with some bullish reversal candles on some individual stocks would give me confidence to go buy in, because it would be telling me that hey, the downside move is probably getting close to being done. Now, I'll tell you, there's a lot of people out there on CNBC, I hear it all the time, that say, well, the Dow Theory may have worked in the past, but it doesn't work as much nowadays. The economy is much different. We have a lot of service-based, what do I need to know about airlines and railroads for Netflix? What does that have to do with Netflix or Amazon? Well, Amazon you'd be transporting things, but Google or Facebook or something like that. We have a different economy, and there is some truth to that, but there's still an economy that has to have transportation that moves stuff around, and whether it's going to continue to be railroads or it's going to be drones or whatever the future holds, I still feel this will work. And every time I've heard people say it doesn't work, just like I showed you within the last year, there was a case where it totally worked. I think the problem is when people try to use it as a primary part of their decision. It shouldn't be part of a primary part of your decision. It should be part of the process. And to be honest with you, I don't look at the Dow, the transports versus the Dow, unless I'm expecting that maybe some reversals taking place, whether it's bearish or bullish, and I'll start to kind of pay attention or look at it. Now, I will add a new twist to the Dow theory, though, that I think you can add to the process, which also kind of takes into account kind of the modern conditions we're in, the technological position we're in as an economy. You can also use the chip sector in a very similar way. And so I like to combine them. I like to look at the Dow transports. I like to look at the chip sector. Now, you can follow the chip stocks through the ticker symbol SMH. You've seen me pull this up a few times. Now, if you want to, if you say, okay, well, you know, what do railroads tell me about Facebook or whatever? Okay, well, then we can add the chip sector in there, and it works kind of in a similar way. Obviously, every computer or technological process out there needs chips to run them. So when chips are in high demand, it can tell you that the technology stocks are doing well or tend to be doing well. When chip stocks are underperforming, usually it means that the technology stocks are likely to kind of follow it, and it kind of is that leading indicator of I kind of use it with the QQQ to kind of in the same type of way. So we had with the chip stocks right here, we had them break trend at the same time when the NASDAQ did. So you had this move up right here. Chip stocks have broken trend. Now chip stocks came all the way back up, and they've almost gone to a new all-time high. But today they've reversed. Today you've had a bearish day, despite the NASDAQ 100, the QQQ, going higher. So we'll see if that's maybe an early warning sign that maybe the NASDAQ's going to follow or could follow. I'd also point out, though, that we are near an all-time high. If the chip stocks reverse and manage to go above this previous all-time high, that maybe there's a good chance that the NASDAQ 100 follows. That's something I'll be watching pretty closely over the next few days to see if that happens. Okay, because that could be an indication that maybe we are going to see the Qs break out as well. So anyway, those are two indicators that you can kind of keep an eye on. Usually when there's something significant that's happening, I'll point them out in some of the updates. Like I said, I don't look at them every day necessarily, but whenever I think there could be key reversal points, I'll kind of check in on what the chip stocks look like, what the Dow Transportation Index looks like, and it might be a good idea just to watch them a lot over the next as part of your process of analyzing the market, because it's over time when you see it actually working or see it actually warning of things about to happen, that you gain a little bit more confidence in using it. And so, you getting familiar with that, making it part of your regular analysis could be a pretty good thing. Just again, I must emphasize, just don't make it just because the chips are down and the NASDAQ 100 is up, I'm not going to go out there and buy a whole ton of puts on the QQQs. I'm not going to go nuts expecting that we got to get a drop because one day it was down and the NASDAQ 100 is up. But I definitely am paying attention, and I definitely would go look for stocks, individual stocks that look like they're weak or could go lower, just in case the market reverses and I can jump into those stocks and profit on them going down, buying put options or something like that, or shorting them. So that's definitely something you can consider using in your analysis. All right, thanks everyone. We'll see you on Thursday for the stock specific class. Bye now.